rental forecast in these non-CBD locations is pretty flat, frankly. The odd thing that seems to happen is that, look at South Bank there. What's really driving rents in some of these locations is the introduction of new space at a much higher quality. It tends to create this step change, rental up to a new level. We think that might continue in some of these locations in the next development cycle as well, as new stock continues to come into the market at a time when, remember, when vacancy is low and falling in the CBD. So there could well be an opportunity to capture tenants who can't be satisfied in CBD locations. So let's summarise the city fringe and suburban office outlook. We think the new pricing levels should attract more buyers. Remember, the value has washed off through the change in cap rates, but that won't all turn around overnight. It might take 2 or 3 years for yields to get back to a long-term average. Yields are less likely to compress in the year ahead. Adding value, we think, will really be restricted to the income side, and it won't be an easy task in non-CBD locations. We think vacancy will gradually fall in most places, although we do note that St Kilda Road will suffer from some tenant moves in the year ahead. And development activity, although it's more likely now, we're not saying rush out and start building tomorrow, but certainly start getting sites prepared, start getting plans in place, wash off those DAs and look toward that activity over the next sort of 12 months to 2 years. So I'll give you a quick update on how we see the non-CBD markets now and into the future. But to give it a bit more oomph, we're thrilled to invite up to the stage Andrew Dawkins and Grant Tinker. Please join me in welcoming them to the stage. Okay guys, let's have this conversation talking about 3 separate sort of sub-markets, if you like. We're going to start with St Kilda Road, move to the city fringe and then the outer suburban areas. So let's start with leasing in the St Kilda Road precinct. I mentioned that this performance has not been, as a market overall, not been quite as strong as the CBD. But things are picking up in the CBD, so is leasing inquiry also now picking up in St Kilda Road?
Yeah, thanks, Kevin. Yeah, it is. We're busy. We're busier this year than we have been in 2009. The phone is ringing and deals are being done. So far this year, it's late February and we've already transacted 4,500 square metres of office space in 3 buildings. So we're pretty bullish about the year. Yes, it has been knocked around a little bit. There is a bit of vacancy, but it offers a very affordable alternative to a lot of tenants in Kilda Road precinct. So again, stressing, we're pretty bullish about the market this year.
Do you think as rents rise in the CBD, it'll be something of an inner city sort of haven away from those rising rents?
Yeah, I think it's a natural rollback for tenants to come from the CBD. We're seeing, as Shane was saying, that the rents are going to increase. We can see as an attractive option for tenants to be located close to the CBD with a vast, a fairly dramatic difference in the rental.
So rents down there must be, what, 25–30% there?
Yeah, we'll leave it at that. I mean, from an owner's point of view, they probably need to be a little bit aggressive with deals and a bit flexible with how you structure a deal. But it'll certainly be dollar driven.
Okay, so what about the investment market in St Kilda Road, Andrew? I mean, is there a clear strategy for owners and those wanting to get into that market in the year ahead?
Yeah, well, first of all, there's a lot of people still wanting to get into the St Kilda Road market. They're always seen as trophy assets. They don't trade that regularly, and they're at a good price point. But I think what's happening with that tenancy profile getting a lot smaller is that it's becoming more management intensive, and that plays more into the hands of a private investor than it does to some of the funds. And Kevin, I don't know whether you got the slide that
There we go.
I put up. I put a lot of work into this table, as you can see. But it really just goes to show you that the profile is increasing year on year in terms of private investors entering that market, and I think you'll see that continue moving forward.
Okay. So let's move to the city fringe markets for a moment. They're quite different in that what's characterised the city fringe markets in the last couple of years is more development activity and newer stock coming into the market. How has that impacted on the leasing side first, Grant?
Well, the fringe market's probably 2 markets within the fringe. Kevin, you've got the South Bank region where you've got Freshwater and South Wharf, which were spec-built developments. They've gone very well. on completion, just about 100% occupied. And then you've got the slightly outer fringes of Richmond's and Abbotsford, where there was a phase of a fair bit of stock coming onto the market, which has sat there for a little while. But again, that's transacting this year, and I think reading the press in the next 3 to 6 months, you'll see some deals occurring in that Richmond-Abbotsford area, which will lend to the market tightening up again. So demand, again, is improving.
Okay. And Andrew, on the investment front, I mean, it's quite a dynamic market. We've seen a bit more sort of movement in that market with development activity and investors coming in and picking up newer buildings as well. So what's the sort of strategy in the city fringe for the year ahead?
I think with the city fringe, what we found over the last 12 months is that everyone started gravitating towards the fringe in St Kilda Road when conditions were tough, and the outer suburbs maybe not so much. But what you're going to find in the fringe, I think, over the next few years is that the cycle's turning a lot quicker than people think, and commercial development really will be the go, probably maybe 2 to 3, maybe even 4 years. But to be positioning yourself to be finding sites, particularly with income, so you can get your debt finance, will be the way to go, because a lot of the sites that were suitable were taken up for residential development and converted from permits for commercial to residential. So I really think that's an avenue for people to look at.
Is residential still a popular, is demand for residential development sites still high in the city?
It's very strong, and we've got a few residential developers in the room, so I'll mention a couple of developments that have been successful. But developments such as Clara, the Bank Apartments, Coco, Elm, and there's a number of others that have performed exceptionally well. The residential market's being driven by an insatiable appetite at the retail end for $600,000 and less in terms of price point, and that's being driven again by the lack of housing affordability for existing housing stock. So residential is still firing.
Okay. So let's move now into the outer suburban areas, and especially that southeast area. It was an area that was running quite a few years ago on the strength of the completion of Eastlink. There was a lot of talk about that at the time. Would it open up? Would expand more for more business opportunities? Certainly encouraged quite a lot of development activity at the time and pushed vacancy up. But how's it tracking now, Grant, the leasing inquiry in those outer suburban markets?
I think the Eastlink has helped contribute to the strength of the established markets of Mount Waverley and Mulgrave and in that general region. I don't think we've seen the massive growth along Eastlink, which we could perhaps predicted a little bit. I think it just underlies the strength of the already established markets. I mean, it just makes transportation and access for the vast majority of the population to get into that Mulgrave, Mount Waverley precinct.
Okay. So looking ahead for the next 12 months, why don't we summarise some of the key sort of pieces of advice for owners dealing on the leasing side in the 3 sub-markets we're talking about and the investment side?
All right, we'll start at St Kilda Road. It's active, the market's pretty active. It's smaller deals, smaller inquiry, so we need to do more deals, but it is active. The phones are ringing again and tenants are wanting to do deals. So from an owner's point of view, you've got to be flexible and show different ways to structure deals in that market. And again, we hope to look forward to a bit of a rollback of inquiry from the CBRE into that St Kilda Road precinct. From the fringe market, well, we just see that as tightening up a little bit, South Bank and, as I mentioned, the Richmond and Abbotsford precincts. And from the outer east market, there's the older stock, the stock that's sat there for a few years has been absorbed. There's not a lot of options for tenants looking for sort of 3,000, 4,000 square metres. So if there's a business park out there that's established, that's the potential to be a bit counter-cyclical and look at potentially, dare I say it, speccing a building out there, I think now could be the time to do that.